Hey everyone, the June CPI number, aka inflation, came in at 9.1%. Expectations were for 8.8% annual increase, so this was an unpleasant surprise. This huge spike came after the Federal Reserve raised interest rates by 75 basis points at their last meeting and indicated that more and higher rate increases are in store. This increases the likelihood of the Fed enacting at least a 75 basis point and potentially a 100 basis point increase at the Fed meeting at the end of July. The Fed raising rates so quickly and by so much could not only cause havoc in the bond and the equity markets, but it will increase the widespread assumption that if we aren't already in a recession, we will be at some point in the near future. Now, both inflation and recessions are susceptible to sentiment. Specifically, when consumers think inflation will increase, it very often does. Fed Chairman Powell alluded to this relationship in the comments after last month's meeting, and the notes to the meeting made it clear. The Fed didn't just look at the inflation number, it also looked at the University of Michigan consumer expectations data on inflation, which showed an increase. Recession expectations work the same way. When consumers and corporations begin to fear recession and then make substantial changes to spending behavior, this has a ripple effect across the economy and leads to more economic cooling than would be indicated by the monetary policies the Fed is making on their own. It becomes a negative feedback loop. And this is the problem with the Fed using past tense data to fix a future tense problem. The Fed's move to slow the economy have an impact beyond tightening the availability of money. It's challenging to know when and how much to raise rates because factoring in the future behavior of all the actors is impossible. The challenge for the Fed is to decrease money available for investment for corporations and consumers and communicate its serious intentions to continue doing this until it hurts, but not so much that everyone loses hope and refuses to participate. It's kind of like some aspects of parenting or training a Cocker Spaniel. So will the Fed increase rates more? And are we headed for, or are we in a recession? A famous Sherlock Holmes quote is data, data, data. I can't make bricks without clay. So what is the Fed's clay? Let's take a look at the strength of the labor markets. Fed Chairman Powell has called the labor market unsustainably high. This is both underpinning the economy and a rationale for raising rates. The Fed has indicated that continued strong labor market may mean that aggressive rate increases will not increase the risk of recession. Now, the U.S. Bureau of Labor Statistics reported total non-farm payroll employment rose 372,000 in June, and the unemployment rate remained at a small 3.6%. Now, what about consumer and spending? Money talks, right? Well, consumers are still gabbing away. Retail sales rebounded in June, increasing 1% as reported by the Commerce Department. Even accounting for spending on gas, which are going through the roof, retail sales still rose 0.7%. How about consumer sentiment? Michigan football may no longer capture attention, but the University of Michigan's Consumer Sentiment Index surely does. The preliminary reading for July ticked up slightly off the historical low of 50, and that it hit in June. Let's look at GDP. We won't have an official estimate of GDP until the end of the month, but the GDP Now model estimate for real GDP growth in the second quarter is negative 1.2%. The bottom line, well, are we in a recession? The National Bureau of Business Economics is the accepted authority on recession. The standard definition of a recession is 2 consecutive quarters of a contraction in the economy. If the official estimate of GDP comes in negative, the economy would fit that description. But those aren't the only factors the Bureau uses to determine when a recession starts. The Fed will likely increase rates by 75 basis points in July, but given the positive data on consumer spending and sentiment, it may feel that a 100 basis point increase would do more harm than good. For investors, whether we technically enter a recession or not may be beside the point. The shortest recession on record was in 2020. That was at the beginning of the pandemic. And even if the economy is headed into a recession, given the other positives, it may not be deep or long-standing. As always, consult with your financial professional and don't make wholesale changes in your financial plan unnecessarily based on headlines that might be very different in the not too far distant future. I'm Christopher Klepp, and this is your Bridge Towards Wealth.